Lumos gets brought up on just about every episode these days because they are changing the way SBA loans are underwritten, especially small loans. So I wanted to take a second to explain the power of Lumos. So here's how it works. Lumos' scoring model, Prime Plus, leverages over 1 billion data points to come up with a predicted expected loss. So now you can quickly and efficiently decision each new loan request. Guys, we're talking about auto decisioning on small loans up to $500,000. They'll even sit down with you to build out a customized credit profile that matches the risk tolerance of your specific institution. Lumos is defining the next chapter of SBA lending, and it couldn't be coming at a better time with the rise of the small loan program. By the way, you can use Lumos to score your existing portfolio too, so that you can see where the weak spots are before there's a problem, and that way you know where to focus your resources. Let Lumos take your small business lending to the next level with cutting-edge analytics by going to lumosdata.com and scheduling your demo today. Hello and welcome back to the Art of SBA Lending. I'm your host, Ray Drew. Halloween season is upon us, and this episode is number 13 of our Town Square series, my lucky number. And so we're going to do something a little bit different today. Instead of one big idea getting talked about, we're going to touch on a variety of different topics. First of all, we just closed out fiscal year 2024, and I don't know if you looked at the numbers, but damn. One bank cleared $2 billion for the first time in the history of the 7A program. 4 banks reached $1 billion, first time we had that many in the history of the program, and about 9 other lenders put up $500,000 or more. It's getting crowded up there in the top 10, and we're going to break down the impact of the big getting bigger. Next up, we're going to break down what to do when the SOP doesn't have the answer. See, the problem with the SOP is it's written in black and white, but business is done in the gray. So where do you turn? Who do you call? How do you handle actual real-life situations that land in that gray area? And then finally, we're going to close out the episode with my answer to the question, what's the one thing you would change about the 7A program? My answer is quite bold. Let's get rid of the pledge all available collateral rule. So stay tuned and you'll hear my reason why. And then our panel is going to break it all down. So without further ado, let's bring in our panel. From sunny California, we have with us Bob Coleman, founder and publisher of the Coleman Report, Brian Carlson, SBA Managing Director at Mission Valley Bank, and Darren Davis, President of SBA Lending at Colony Bank. Folks, welcome to the panel. Darren, I'll start with you. The top 10 lenders accounted for 33% of 7A production this year. 5 years ago, it was 25%. The big are getting bigger. What does that mean for our program?
There's concentration risk, obviously. The bigger they get, the more loans they do, the more risk it is for SBA. Doesn't mean it's necessarily a bad thing, but it's actually, an interesting trend. I'm actually kind of surprised, after coming out of PPP, I think I would have thought it would have diversified some more, but it's actually done the opposite.
Brian, what's your take on this?
Well, it is interesting. And certainly, I think a lot of us SBA lenders like the idea of getting to scale because it really makes the economics work better. The funny thing is that, I've been in lending a long time, and you look at consumer lending, like an auto loan or a home loan, you can pretty much get the same deal at almost any place. It's kind of the same paperwork, the same everything. But commercial loans, especially SBA loans, are really custom. I mean, they're very unique. And so I would say it's kind of like the difference between building tract homes and building custom homes. And so to do such high volume with, a product that is unique and requires, very careful analysis on each transaction to make sure it's eligible and you can collect a guarantee is quite a production. And so you kind of wonder how, it's certainly quite a management feat to be able to pull this off accurately. So you kind of wonder how they're actually doing when they get to such high volumes.
I agree. I think we should also add in there too, just looking at the list, the average loan size are small too, for a lot of them, under 300,000. Yeah. So, it's just do what you do. Do these people take off because of that? We're able to really scale up their SBA and have loans that probably were conventional before shifted to SBA type deals now.
Well, and the 4 at the top have been doing this a while. A couple of them started around 2010. One of them I'm not sure, but they've been around since I've been doing this. The other one kind of got in a little bit later. They're number 4, but they had a good background when they came in because they bought the CIT portfolio. That's Ready Capital. And I mean, one thing about growing that fast and that big, it's you're doing growth every year and you're just in a constant state of growth. And that's where the problems come in. But I'm curious, Bob, like, why do you think this is concentrating here at the top of the list? Like Darren said, like we would think there'd be more banks coming in after PPP, kind of spreading it out, but you're seeing the opposite.
I'm going to give you a long-winded answer, which is what I do. I maintain that Main Street entrepreneurs are a lot smarter today than they were entering the Great Recession because of the internet, because of automation, because of a lot of expertise they can grab. Bankers are no different. They're able to scale. They can get access to how to improve their efficiencies. So I think that's a logical extension. I maintain we are all smarter in 2024 than we were 20 years ago because of the access to systems, and we're able to take advantage of that. Ray, but what I find fascinating is if you look at the list, and I have it up under the screen, there is only one non-bank lender in that top 15. As you mentioned, ReadyCap sitting at number 4. Now you can, guys, please fact check me. Brian, you've been around longer than I have. I don't know. But I don't remember those few of a non-bank lender 10, 15 years ago. Non-bank lenders were 5, 6, 7 of the top 10. Now we're talking, congratulations to Barry Sloan at Newtek. They've done a great job. Live Oak, they've lost their number one ranking, but they were consistently number 1 for 6 years in a row. Huntington National Bank. So the banks are doing great. But one more fact, and then I'll get off my podium. Ray, the Fed just released a study yesterday. 43% of small banks are not involved with SBA lending. And I think that's even more of an outstanding number than the concentration at the top. I think a better question is, why are 43% banks not participating in this program?
And I think I know the answer, and I think it's our second segment, and so we're going to get there, and that's a great lead in. But first, I want to go back to Darren on this because you're right, Bob. Top 10, and only one non-bank. Now, Newtek was a non-bank for most of their run, but now they're a bank.
Fair enough.
But I am half the lenders at the top are the big boys. Half of them are Wells, TD, B of A, U.S. Bank, and Chase. Are you surprised, Darren, that half of the top 10 are the big banks, considering like they have historically had a reputation for not lending?
Not because of do what you do. I think that's exactly what helped these big banks out. Is now, I don't know for sure, but they can put it in their algorithm and decide which way it goes, right? Does it go conventional? Does it go SBA? Use the same process? And it was a lot easier for them to scale now because they don't have to change anything. I think that made it easier for them to get more involved with the program.
Yeah, because they're doing mostly the small dollar stuff, right?
Yeah. I mean, they're looking at it right now, like the banks you mentioned Bank of America is a little above 500,000, but the other ones are below 300,000. So that's what I think happened.
So Ray, the interesting part of this is that if you're a publicly traded bank and you're doing that much SBA, especially if you're not one of the too big to fail banks, SBA lending will have become a significant portion of your earnings. And so, as you know, publicly traded companies, they don't want to have earnings worse than the prior year. And so it does become a pretty interesting chase to keep improving, at whatever your growth target is every year. So, but I think once you get too high up there, the air is pretty thin. It's not so easy to keep growing at that level. So it'll be interesting for some of them.
That's a good point.
Brian, you're absolutely right. Not only is the air thin, but you are putting a target on your back.
What do you mean by that, Bob?
Historically, SBA, and rightly so, I don't think there's any criticism of the agency, is if you're a number 1 lender, number in those top 5, you're doing that type of volume, SBA prudently needs to take a look at your practices, at your internal policies, and your portfolio. So I don't think anybody in the industry has a problem with that. But if you're out there and you're leading with number 1, you're inviting all certain scrutiny, so you better be able to handle the heat in the kitchen.
I got you now. Yep, makes sense. Brian, you mentioned earlier, like the economies of scale, like, what are the advantages, and let's go into the disadvantages of being a mega shop like that compared to like a mid-sized shop like yours and mine?
So obviously we run an LSP, so we know a lot about the process, and it's, a lot of our success has just been based on having great people to underwrite, process, and close these loans. And we have really good execution. And so, I look at, I think at Mission Valley, we're, at least as of August, we were like 49th in the nation in terms of production. And so, but, to scale that, from where we are up to, say, the top 10, it's like, wow, can I find enough great people and to effectively manage that process for all those loans? It looks like a really tough job. So that's kind of where I was going with that.
So like the disadvantage might be, you run out of A players to hire. You've got to kind of train new people, or you're just trying to get bodies in there to process everything. And then that might take a toll on different aspects of the business, maybe compliance, maybe customer service, that type of thing.
Well, I think process management, I'll give Live Oak credit. I mean, they are really good at process. It's what they've accomplished is not an easy thing just for everybody to say, oh, well, we'll just do what they're doing. It's a lot of work to put that all together.
They make it look easy.
Well, and the advantages though, Brian, would be like, I mean, if you have that type of scale, I mean, you probably could just hire the people from the SBA or something like that. You know how like companies like hire from the government and they go from the government to now you're inside the shop. Like imagine hiring, I mean, I'm sure someone's done that where now you have this insider kind of in your shop to give you a little bit of an edge. Like that's one thing I can think of as an advantage. Can you think of any others?
Well, no, that's kind of what the challenge is, I think, is just finding great people to support growth is just not that easy. And
the talent.
We've got a guy that's kind of head of our credit underwriting who kind of knows the SOP inside and out. And, it's like, gosh, if you had to replace him, that would be a tough task.
Right.
Inexpensive.
Yeah. I would also say another disadvantage could be too, just look at it as a bank or the lending institution as a whole from a return for shareholders. A lot of times if SBA becomes a too big part of the income, it doesn't trade as well as other banks that are more diversified too as well. So that's something you got to be.
All right. Well, that's true. But, I don't want to be too biased here. There are definitely disadvantages, but I'm just trying to do this. Like I'm trying to play this out of like, you know what, if I had $2 billion portfolio, is that probably maybe more, and you have all that interest income and servicing income coming in. I mean, think about what you can do, with that type of sort of portfolio. I mean, you can then just, I feel like after a certain point, you can get so big that you can price differently on your loans. I mean, when you're a young shop, I feel like you kind of have to maintain a certain level of pricing. But if you get to a certain point, you might be able to build economies of scale to where your profitability is such that you can actually offer lower pricing. And in a world where we're a commodity, that can make a huge impact.
Yeah. And I think you sum up what Live Oak Bank did, really. When they started off, they were, probably full pricing. And today they're definitely one of the lower priced SBA shops out there.
That's what I was thinking. And when you can nail execution and be one of the cheapest, right, that's an advantage. Bob, I saw a clip of you online interviewing a young Barry Sloan from Newtek in 2010. Now here they are, number one SBA 7A lender in the country. What do you think Newtek is doing or has done to be able to get to that point?
It's no secret, simply execution. We all know what we need to do. We all have the same SOP. We all know how to do it, but he has devised a system of logistics and execution. And he's morphed from a non-bank lender to buying a bank, and they've done very well.
But I think Newtek also was a company made up of multiple subsidiaries that did like websites and payroll and other like multiple services for small businesses. So they essentially their marketing in one way was, marketing a number of things, but finance is always something that's needed by small businesses. So they kind of have an in that way.
If you've been a fan of the show for a while, then you know one of my favorite companies to work with is Rapid Business Plans. Last year alone, their business plans helped facilitate over $600 million in government guaranteed lending. They're on track to beat that this year. More and more small business lenders and their borrowers are relying on Rapid to help with the business plan, projections, and assumptions because their team goes the extra mile to ensure everything is done fast and done right. And that helps streamline the process. They're great at export business plans, by the way, which are critically important at protecting that 90% guarantee. Rapid also offers feasibility studies, which tells you if the project is, well, feasible. I would recommend these for any large startup loan because it protects you and it protects the borrower and helps you get more good deals done. Go to rapidbusinessplans.com to set up your Get Acquainted call today. Find out why so many top producing BDOs recommend Rapid to their small business borrowers. We're going to leave a link in the show notes just for our Art of SBA listeners. Now let's get back to the show. With Live Oak and NewTek being number 1 and 2 volume-wise, aren't they the two that built the proprietary software for themselves earlier than anyone else was doing it?
I wouldn't disagree with that statement. I think you're right, Ray.
So Live Oak built Encino, and that has been their system. But I think anybody that's doing certainly top 10 these days has got to have pretty good system.
Yes.
Yeah, but do you get the good stuff or do you get this like secondhand stuff? I don't know. And I think the big thing was they got ahead of the curve. Like that ended up being the thing that created a lot of efficiencies for a lot of banks in our space. And they were the first ones to realize that and invest in that. So thinking ahead now, the thing screaming at me is AI, right? No one's really implemented like AI into their process. Probably some, and there's probably some machine learning, there's probably some chatbots, there's probably some stuff, but we've just unlocked this whole new thing with these language models and these last couple of years. And, we're in a pretty stale industry, but like, I feel like if somebody could nail, that, they're going to own the next, 10 to 20 years in the industry. Anyone dare to weigh in on AI?
The tricky part about technology is that the technology is moving faster than we can keep up with it, just as humans. I mean, to always be learning kind of the next new thing out there and not just learn how to implement it, but how to really use it as a tool. And so I think that is probably going to be the thing that slows that next step, Ray.
Yeah.
I think the other issue too is, if you mention Live Oak and NewTek, they're more of a tech company first, then a bank, right? So banks are banks first, and they have a hard time accepting technology. We're I think as an industry, we're pretty far behind others, and it's like you said, Brian, it is changing so fast. You have to have a resource available for that for the future. I think for banks to survive. It's really tough for small banks to scale right now without that technology.
But it takes an early adopter to prove it out. So Live Oak and NewTek proved it out. Now everyone's buying Encino, Spark, Lender AI, whatever, you name it. But we're all kind of following, right? So what's that next thing that somebody's going to figure out and then everyone's following? Whoever figures that out that's what I'm saying. They're the ones that are going to be moving up the ranks going forward.
Absolutely. I agree with you on that. That's the issue. They're a technology company first, so they're the ones who are, probably Live Oak is testing out AI as we speak, I would imagine.
Oh, absolutely.
In looking back a little bit, in 2006 and 2007, we had CIT up there at the top. And of course, the financial collapse and eliminated some of those lenders that were up there. We've been through a lot of turbulence these last few years, Bob. And, the folks at the top, they just seem like they aren't going anywhere. They all want to grow even bigger. So do you think getting too big to fail becomes an issue here?
No, I don't. Not in the SBA lending world. Even though NewTek was the first, I believe they were the first $2 billion lender. Live Oak, actually, I think Live Oak hit $2 billion a couple of years ago. I could be wrong on that. But as a percentage of the overall program, they're still less than 10%. So you don't have a dominant player where someone has 30 to 50% of the market. So I don't think that is a concern in our market. It is still, to use Brian's analogy, you still have to build it and you still have a lot of hands touching it. So we're not at the point yet where we can streamline these as we can, say, a credit card application.
All right, let's move on to the gray area of the SOP. Let's move this conversation. So Brian, in your shop, do you have like an SBA guru that helps navigate through those gray areas of the SOP?
We absolutely do. And unfortunately, we've been doing this a long time, so we've got good contacts to kind of verify things. And, obviously anybody can ask SBA questions, but it really comes down to, there are just areas where we come across, or situations we come across where it's like, well, it's gray enough that SBA might interpret this differently than we are making our credit decision, and therefore we're going to lose the guarantee down the road. So in those cases, you really don't have any choice but to submit the loan GP and let them opine on your credit decision or whatever that SBA issue was.
That's true. GP is always a option, but that doesn't fully protect you, right? I mean, if you send a loan GP, but then misstep in closing, Brian, couldn't the guarantee still possibly be in jeopardy?
Absolutely. You can mess up the guarantee in closing or in servicing, but it kind of gets you past that credit approval. So, I think maybe an obvious situation might be a projection loan where, it's hard to really substantiate the projections. That might be a deal where you say, well, we feel comfortable with the borrower, what they're going to do, but we'd want another set of eyes on this. Obviously, you have more exposure if you're doing an undersecured loan, and so if you're doing something that's got $2 million plus that is unsecured, it probably makes sense to make sure that they've at least agreed with your credit decision. And obviously you just better make sure you get the documentation right and track the loan properly.
Well, that's interesting because, I've always thought they're kind of looking at eligibility. I would feel like they're not going to decline a projection-based loan because it's a projection-based loan without collateral, right? Aren't they just looking for eligibility, Brian, when they're looking at that? Or are they actually kind of deciding, is this a loan we should be doing?
So my understanding is they can come back and say, look, these projections don't make sense or they're not fully supported. Because of that, we're going to deny the guarantee, or that's why ultimately that's why the business failed. So we do carefully go through projections on those types of deals and make sure that there's a good logic behind it that can be supported. And obviously we want to do that for ourselves because we don't want to make bad loans. We want to make sure that they've thought this through.
So Darren, when you have a situation that comes up and the answer is nowhere to be found, what do you do?
A couple different things. We do use 7-8 questions, but that's got to be careful there sometimes because not all the facts are said, and sometimes depends how you phrase it in your email or the answer you get back. So we usually start there. We also utilize Nagel too as well. They have a good system there too, and also reach out to others before we kind of make the decision to go GP. I mean, right now, the biggest issue is with all the changes with the new SOP coming out, there's a lot more gray area of how things are being interpreted. So we've seen a little bit more higher uptick with us of sending the things GP. It's been a little bit easier just because we now use a loan origination system that makes it easier for us to get it through. So it's not as big of a deal to go GP as it was beforehand. But we're also seeing inconsistencies with general processing too as well. We recently had a deal where it's pretty clear what the definition of an associate is, that it's a 20% or more owner, an officer, director, or whatever else. We had a minority owner that was a business that wanted their debt to be refinanced. We had to escalate that one up the food chain because we were told it wasn't eligible. So there are inconsistencies both ways from the SOP changes.
When you say escalated up the food chain, do you mean that was a GP submission that was they said decline and you were able
Yeah.
to get it overturned?
Yeah. Well, it wasn't officially declined. They actually, I'll give them credit. They came back to us and said, if you restructure it as a partner buyout, we'll do it. But that wasn't what the customer wanted. Also, this was an international trade loan as well, too, which wouldn't qualify underneath that. So we happened to be at a conference, actually, and someone walked up to someone at SBA there and said, "Hey, I need some help."
And that's the
works.
value of those conferences.
Yeah, exactly. So that conference more than paid for itself a lot. So that's another thing, too, is also having contacts with the SBA. Now we have one that we can reach out to with those tougher questions. So,
well, it's fascinating then, because, if you were a less experienced lender, you may have gotten that email and just accepted it for what it is and not known to maybe push back a little bit. And so it's like, I feel like even the SBA is living in the gray area sometimes. We're all flying by the seat of our pants. I had one the other day where there was a seller note being used as part of the injection on a business acquisition, and they tied a forgiveness clause to it, meaning if the business dropped below a certain point after closing, the borrower didn't have to pay that seller note back. Now, it had the 2-year standby. It had the fully amortizing term. And I thought, well, clearly, if the business dropped after closing and there was this benefit to the borrower, we'd be fine. But let me double check with a trusted resource. And sure enough, the guidance from them was the opposite of what I thought. Bob, if only there was a place you can go to get the training that you needed to compliantly underwrite and close SBA loans.
That would be awesome. That would be awesome.
But in all seriousness, how do you recommend banks approach these gray areas with the SOP? And you can't say the word prudent. Go.
I'll start with Darren. Conferences are great. Networking. There's an advantage to having a little gray hair with years of experience in seeing a lot of different scenarios. I'm fortunate. I have Lance Sexton who does our training and closing. I do the training and underwriting. We have an online course, so we add to the mix. I would encourage it's training. It's interesting. One of the first questions the SBA asks in the review is, hey, where's your training records? And anything you do, any conferences you go, NAGO, NADCO, especially the regional conferences, they are great value. Go to those and document them. So talk to people. And as you said, look, that's the nature of lending. It's underwriting risk. It's gray area. And the underwriters in a difficult position, they have to pull the trigger to make that decision. And there's a lot of different factors. And one of the factors is eligibility. Is this going to work under the SBA lending program? And how can I defend it?
Well, a lot of the times at the conference, they will point to prudent lending. Now, here's my problem.
I didn't say that.
I know. And I appreciate that. But here's my problem with prudent lending. Being the answer, not the problem with prudent lending, but the problem with prudent lending being the answer to all our problems. What's prudent for me might not be prudent for you, Brian. I could take any scenario of a gray area situation that I've encountered, and I could make the argument either way. Prudent lending's a scale. Let's say there's a business acquisition where the landlord doesn't want to sign a landlord consent form. The SOP says you should get this if a substantial portion of the collateral's in that property, in that building. Well, what's substantial? Is it $50,000? Is it $500,000? Is it a percentage of the loan? The SBA leaves this to the lender to give them the freedom to maneuver. But when the deal goes bad, or if the deal goes bad, lenders that have been doing this a while are terrified that SBA is going to come in and say, well, why didn't you get that? And deny the guarantee. So, Brian, do you think that maybe these gray areas are, maybe traps is too strong of a word, but a field of landmines that the SBA can use to get out of honoring the guarantee?
Yeah, certainly you have to make a decision, not only a credit decision, but okay, are we safe on this, and just kind of weigh the risk of sending a GP and having to create delays, which in some cases you don't have time for delays, or just doing a PLP. And so it gets into the whole art of SBA lending, the subjectivity of it that you need to balance. And I guess, that probably comes with experience.
And Ray, I probably wouldn't call them traps, but I know where you're going with it. I mean, the biggest thing I see is just documenting why you made that decision, so you can for me, my personal test is like, would I be comfortable, just going to a newspaper, being televised, whatever it is. Can I stand up in front of someone with a straight face, sell it, So that's my personal way of justifying it. But, there are a lot of gray areas in origination and servicing and so forth. But documenting why you did it usually will provide SBA enough of the evidence, unless it's just blatantly wrong, right? So I don't think they're out there to gotcha at all. But I think you just have to make sure you have it documented well why you did something. So
I agree with Darren 100%. You're absolutely right on that. When you read these Inspector General reports on how they want to deny guarantees, Ray, for example, projections. Well, we're going to deny this guarantee because the lender didn't even address projections in the underwriting memo, and they have a restaurant that they're showing a 40% net profit before tax. Well, that doesn't work in the restaurant business. So I agree with Darren. Document it. Tell them why you made the decision. And SBA is pretty good on going along with, okay, we understand where you're going. It didn't work out, but we understand what your thinking is.
It's basically explaining what prudent lending means to you, right? Putting it down on paper.
Yeah.
Your
I
scale.
take a shot. Yeah, well, that's the thing, guys. I asked that question because I don't have that much experience with, getting the guarantee honored, right? Coming from a sales background. But when I go to the conferences, and even when I talk to you guys, I hear the SBA is not out to get you. That's what I hear from the SBA. That's what I hear about from a lot of people that are really smart. But then when I go sit in the rooms in the conferences, like I was just at this week, I hear what I kind of like more of the tone of the question of like, well, if we don't do this, and this, they're going to find a way to try to get out of honoring this guarantee. And it's just like, there's a disconnect there. It's almost like maybe it's just a PR issue, because I have heard the stat that the SBA honors like something like 97% of their guarantees.
Correct.
So getting back to the earlier point, Bob, about the big getting bigger, do you think part of the reason is that the smaller shops just don't have the knowledge or resources necessary to navigate these complex challenges?
I think that's a fair statement. You can imagine, I referenced the 43% of the banks that don't do it. And this Fed study says they don't feel they have the people. But you can imagine being on a director of a small community bank, and we had this SBA loan, and we think we have $1 million guarantee. And all of a sudden there was a mistake, and you get the letter that says, we're going to deny this guarantee. We want our money back. That kills the career of the SBA manager and is a huge hit for a small community bank, unlike some of the too big to fail banks. And then the directors and the management says, we will never touch this program again, even though you can say, hey, SBA pays 98% of the time, gang.
Right. Just a matter of getting that training. You got to do it right. You got to be all in with it. So I'm a huge fan of the program. Little secret there for you guys.
I think
let's shift gears now to the last topic. The SBA is notorious for their incessant desire for collateral. The thought is that they want the entrepreneur to pledge everything they have first, so that in the case of a default, the bank liquidates all of the collateral and the government guarantee is only being applied to whatever that loss is left over. Now, the perception from the small business owner is that that's excessive. You have my personal guarantee. Now you want to lien on my house? What's next? You want to take my firstborn? We've all heard that one. Now, if they don't have any real estate, it's no problem. The SBA is fine taking on all the risk. I think that there may be some unintended consequences and some unfairness with this rule, and I, for one, think we should get rid of it. First of all, it penalizes people who own a bunch of real estate, and it deters them from using the program to start, buy, and expand businesses. Tying up all of somebody's real estate wealth in order to finance a new project is just not going to work for many. And the cost to lien a bunch of real estate, pay the state transfer fees or the lien fees or whatever, the title insurance, it all makes the program less affordable. Meanwhile, if you have no real estate, there's many lenders that have no problem giving you a loan. So we're penalizing people that choose to invest in real estate versus the stock market, and are encouraging folks to essentially lever up their real estate before coming to us for the SBA loan. we're also removing their ability to get liquidity out of their real estate by placing liens against them. And that does a disservice. And also, finally, are we really going to cut a check for $1 million to go after 200,000 in equity or whatever, 300,000 in equity? Like, I just think it's time we rethink this rule and consider how many more high quality entrepreneurs would consider getting an SBA loan if this requirement was gone, and what the impact to jobs and the economy would be. Now, Brian, do you think that the all available collateral requirement is keeping people from using the program? I mean, I own 4 properties. I don't want to tie them up to open a yoga studio.
Oh, it certainly keeps people out of the program, especially people like doctors or whatever that, might want some financing, but, they don't want to pledge everything. Actually, I agree with everything you just outlined, Ray. I think the concern I would have on the flip side is that, there are lenders that are very aggressive, and, then you start negotiating, or borrowers have essentially run around town negotiating collateral on the loan between various lenders. And at the end of the day, the SBA's got to protect the program. We've got to protect the subsidy rate and what essentially keeps us in business. So I think if you had prudent lenders, or maybe if you said, okay, we got to score these things. And so if you have really strong cash flow for 3 years and you have a number of things that mitigate the need for all that collateral, then you can do that. But I don't know about just across the board.
Well, I get what you're saying, but that's the free market. Shopping banks based on rates and terms is the free market. So I hear both sides. Trust me, I do. But Darren, given the SOP has been moving towards this lender discretion with the do what you do stuff, like why not make secondary collateral and those requirements do what you do as well? Some deals, like Brian said, might be fine without a second lien on a rental house, whereas others, the bank may elect to take it. What if we left it to the lender?
I like that idea. And I would also add another issue with all available collateral is a servicing as well. It's a servicing nightmare when someone wants to sell their house, buy another one, or so that's an issue. And 2, on the front end, spouses aren't very happy about it either. That usually kills some deals for us too as well. So, but no, from our standpoint, we really don't count it as collateral for us unless there's a really small first or significant equity in there. So from our standpoint, it really doesn't, we'd rather not take it, to be honest with you, unless maybe we have a first, which has been rare that we've had that happen. But I agree with you on this, Ray, that it should be something, because from our standpoint, we usually walk away from it. But just because it's not worth paying off $1 million or there's really no equity in there by the time it happens anyway. So,
wow. Very insightful. And I'm glad you guys are seeing the light like I am, because I got slaughtered in my last episode for my last idea. But so, because I've always heard SBA lenders call themselves cash flow lenders. So, Bob, why the need for collateral? Is there any downside for loosening this up a little bit?
Well, of course, you always have to balance being, I'm going to say it right, being a prudent lender and getting the money out there. So that's a balance. But there's 2 factors happening. Number one, SBA has said, okay, no collateral under $50,000. That will go up over the years. The second thing is, with the do what you do rule, the next iteration is, okay, we're going to let the lenders decide. We're going to take off the reins and we're going to let them truly decide how they want to structure the program. So I see it moving, albeit slowly. However, you also have to understand, SBA, these people are smart. And I'm talking about the civil servants who run the program, and they want to get capital out there in fair terms. They're horrified of what the fintech lenders are doing on these MCAs and the pricing, and they understand the entrepreneur says, okay, I can get the money today to cover payroll today, where if I go SBA, it's going to take a month, and I'm willing to pay the price. So SBA clearly understands the negative impact on cash flow on these high interest rate lenders, and they're moving, albeit slowly, and they understand slowly, but they're moving toward, we need to offer a product that allows these entrepreneurs to borrow at decent rates. So I see positive things coming.
And you mentioned 50,000 no collateral. Well, isn't it 500,000 and less, this rule doesn't apply?
As long as that's what you do on your other loans. So the answer is yes.
So clearly they think removing this rule will help facilitate more loans.
Smaller loans, yeah.
More, well, because for smaller, but why not do it program wide then, Bob?
I'm not going to defend that position of why they're doing it, other than I will say two things. Number one, the performance rate of these larger loans is very, very good. And that, in fact, is keeping the subsidy rate down for the overall program. And then perhaps the second question you may want to ask, Ray, is when are we going to get rid of that $5 million cap? It's been there for 15 years. If we do so well on these larger loans, let's allow Main Street to borrow more money under the SBA program.
Yeah, that's a big hell yeah. Bob, I'm going to go to you with a big question, and then I'm going to come back to Brian and Darren to kind of close us home. I'm just going to let you guys give some final thoughts. But first, I'm going to give my big question to Bob here. So how do you balance the impact of this program, throughout the economy and the jobs with the cost of the program, right? Because the industry likes to tout the zero subsidy model. But honestly, I wouldn't mind a little bit of subsidy if the results were helping juice the hell out of the economy. So shouldn't we be looking at the program from more of an ROI standpoint and less of a cost standpoint?
Brian and I have been around for a long time. Back, the reason why that trade organizations were started because there was always one group in Congress that wanted to kill the program under the Ronald Reagan administration. Today, we're in a situation where SBA truly is bipartisan. It has support, broad, universal support on both sides of the aisle in both the Senate and the House. So that is a very, very positive thing. The challenge always is getting Congress and SBA to think alike. And when you have differing parties, sometimes they clash inherently. But the answer is SBA is so important for helping small business. If you do on the scale of popularity, small business owners rank very high. Yeah, we like people who do things for the local economy and hire people. So I'm giving a long answer, but I'm optimistic that everyone, private sector, public sector, all have the same goals. It's let's all work together. Let the private sector do what they do best, which is make good credit decisions and let them structure the loans. And then on the public side, give them the parameters. Okay, these are the bumper rails. Do what you do. And as long as you do that and everyone does what they're supposed to do, we're going to have a very good program with very low losses.
Yeah, I can't believe it actually works, but it does.
It does. It does.
Darren, do you have any final thoughts?
I think we all agree on this all available collateral issue. I would take another step on that. You talked about the landlord subordination agreements, and I think that's another thing that's somewhat wasteful of time and money, depending on the collateral. I think they should better define that as far as maybe have a threshold where you don't need, if the collateral value is less than X, you can skip kind of this part because it's time consuming for us. It's time consuming for the borrower. It's expensive. And a lot of times these leases are already signed, especially if you do a lot of business acquisition lending. There's not much you can do. And it's a lot of costs racked up to say that you tried, right? So I think that's something else we should probably look at too.
I love that you said that because it's like we're so programmed into we need this, so we got to go get this. And doing this podcast gives us an opportunity to really take a step back and think, well, why are we doing this? And does it make sense? Because you're right. Think about it's probably $15,000 worth of legal bills associated with that all around. Brian, what about you? Any final thoughts?
Well, I do feel like the SBA is trying to make the program more simple. And they, Bob keeps talking about back in the good old days, it was like,
I didn't say they were good. I didn't say they were come on. I said the old days. I didn't say the good days.
But if you even saw like one or two minor changes to the SOP, it was like a big deal. And now they're making lots of changes. So I can see that they're trying to fix it. And it kind of gets back to what you're saying, Ray. The more actually, the easier you could make this program, the more lenders could participate. So you wouldn't have such a big concentration at the top of that list. But it's going to be able to give more banks the ability to help more of their clients. And to me, it is one of those programs that really does work well for the business community. And, I essentially applaud SBA for trying to make it access better. So hopefully we're on the right track.
Well, I mean, the numbers show we are, and it's incredible. And it's an interesting conversation for another day, because we just had an incredible year in the 7A program. Now defaults are up, but the rates are up, and it's a complex situation. But I think they're looking at themselves as we made a bunch of changes and it's worked. Numbers are up substantially. So, fellas, this was a great conversation. Thank you so much for joining me today. Until next time, ta-ta. All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and The Video Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of The Art of SBA Lending. Ta-ta.